Adrian Mowat, Chief Emerging Market and Asia Equity Strategist at JPMorgan. Adrian, hi, morning. Japan's upgraded its economic assessment for the first time in about 2 months. The BOJ starts its two-day policy meeting today. The yen is weakening further as well, pushing the Nikkei to a new 5.5-year high. What's JPMorgan's strategy now for Japan in particular?
We're very bullish on Japan. We think you've got a combination of improving economic environments, positive earnings revisions, and a stock market that's trading on around 15 times forward, the same level as developed Asia, ex-Japan, and the same level as the US equity market.
Indian, whereas Japan is growing, China is not growing. Chinese equity markets are, however, seeing renewed interest led by cyclical sectors or in companies that are closely tied to the domestic economy in China. How are you advising your clients now to position themselves in China? And JPMorgan in his last report had recommended an underweight rating on China.
Well, we're seeing a recovery in emerging market equities from their April lows. China is doing the same thing. And we're seeing a recovery that's reasonably broad-based, not necessarily just cyclicals. We've had some of the IT stocks doing well, which many people view as growth defensives.
So what are you expecting from Ben Bernanke's testimony tonight? Are we any closer to a possible QE3 exit?
No, I think, these testimonies, the Fed minutes are just noise. We know what the Federal Reserve policy is with regards to zero interest rates and the unemployment rate. We also know that there's flexibility around quantitative easing, less quantitative easing if the economy looks better, more if it looks poorer. I think we know what the strategy is.
Adrian, what do you make of all the positive data out of US? Does this justify market rally we are currently experiencing?
Well, it's interesting. People talk about the positive economic data in the US. This stock market is being led by healthcare, consumer staples, and utilities. It is not being led by cyclical stocks. Why is it being led by those? It's because we're seeing a lot of M&A activity and share buybacks, and they're tending to be in sectors where cash flow projections are easier to make. There are greater confidence in them. So it's defensives that are leading this bull market, not cyclicals.
So while markets in India, Adrian, have certainly been buoyant, they do not quite compare to Japan or US, which has witnessed pushed by, loose purse strings of the central banks. With markets there already having gained about 17 to 25%, is there more headroom for India?
Look, I think developed markets will continue to outperform. This is the worst year on record for relative performance of emerging market equities. Within emerging market equities, we like India, we have an overweight, and it is outperforming.
Adrian, macros in India appear to be stacking up rather nicely. Inflation, both CPI and WPI, is beginning to look more benign, while growth continues to crawl along, way off from the double-digit levels we were hoping once. Does this strengthen the argument for a more aggressive stance from the RBI governor on 17th of June?
Yes, I think there are two things that enable interest rates to fall further. The first is we continue to see fiscal consolidation in India, and there is a requirement for the central bank to work against that fiscal tightening by cutting interest rates. We also now have flexibility in that headline inflation is falling. So I am confident that market interest rates and policy interest rates in India will fall further in 2013.
So what would you pencil in from the RBI for the rest of the year, especially in light of the fact that liquidity deficit remains quite high and the transmission of interest rates cut has been dismal?
I think let's just state that the trend is a decline in interest rates. We're already seeing market interest rates coming off, and that is very supportive for both the private and the public sector banks, as well as non-bank financials.
Adrian, would you say that bond markets in India are also factoring in an aggressive policy stance? The yields are currently at multi-year low. In the light of this, is there any diversification opportunity for investors?
Yes, I think there's a couple of factors at work here. We have perhaps an expectation of further interest rates cuts, although when you talk to the consensus, that doesn't appear to be what's out there. But what we're seeing globally, particularly with QQE in Japan, is that long-term interest rates are extremely low. That's having an influence on emerging market long-term interest rates, including interest rates in India.
The cut in commodity prices, Adrian, was supposed to work in favor of India, but the latest trade release shows that we may not yet benefit from the fall in commodity, given the surge in volume, especially for gold. How will the current account deficit and trade dynamics play out then?
Yes, I mean, if you look at India's import bill, 35% is crude oil. Crude oil has come down to a slightly lower range of maybe 100 to 110 versus 110 to 120. So that's modestly helping. We had seen a decline in the gold price, but in fact that encouraged a significantly increase in the purchase of gold. And maybe that's what's coming through. So I think it's maybe a little bit too early to look for an improvement in the trade deficit, but we would expect that to be a feature as we move into the second half.
Having said that, Adrian, clearly it is the macros that have been a cause of concern for rating agencies as well. S&P has reaffirmed BBB rating for Indian sovereign with a 33% chance of a downgrade in this year, which of course has been vehemently contested by the government. Would you say that Indian fundamentals do not warrant an investment grade rating?
Well, when there was the threat, I suppose there still is a threat of a downgrade of India's credit rating to non-investment grade, the two things that were highlighted was lack of reform and the fiscal deficit. The government has taken both of those on board. We are seeing a reduction in the fiscal deficit. Critically, they keep on increasing the price of diesel. Diesel is 23% of the subsidy bill. Remember, the subsidy bill is more than the primary deficit in India. So we do have them addressing the issues that the credit rating agencies were highlighting. I think the risk of a downgrade is significantly lower today than it was 6 months ago.
Right, so despite the run-up in equities and the FII capital flowing in the currency has been under pressure, Adrian, trading at the lowest level since Jan 2013. Do you expect the INR to continue to be under pressure, or can we see some rebound?
No, I think the currency has found this new lower trading range, and we would expect it to remain around these levels.
Adrian, talking sector-specific, what is the approach for financials, and will private sector blue-chip names continue to, hold away?
Look, I think there's a broad story here for financials. We're overweight public sector banks, we're overweight private sector banks, and non-bank financials. Market interest rates are easing. We are likely to see a pickup in lending activity over the next 12 months as the market responds to these lower interest rates. As the government addresses issues, particularly with the utility sector, the credit risk that was perceived for the public sector banks should improve. So this is a broad statement, go long Indian financials.
Right. What about infra and related sectors like cement? We've seen the monsoon approaching where construction activity generally slows down. But just the same from a long-term perspective, especially with focus on reforms and the valuations bottoming out, can one invest?
I think with regards to infrastructure, we should focus on the Cabinet Committee on Investment, which is attempting to get approvals through for some of these major investment projects that have been on hold for maybe environmental clearances and other forms of approvals that have been required. They are making some progress. I think that is good for the engineering and construction companies and should also be good for the cement companies, because hopefully the market will be able to adjust for the seasonal anomalies of the weather.
Adrian, the rally has been boosted to a great extent by buying in pharma names like Lupin and Sun Pharma, which are now trading at their lifetime highs. Both these stocks have gained about 25 to 30% in this year. Do you think the core fundamentals for large cap Indian pharma stocks are still looking attractive?
Well, remember the answer I gave on the United States. We're seeing the U.S. equity market being led by healthcare. There's a lot of M&A activity in healthcare, and I think that's supporting healthcare prices globally. Now, if we specifically look at India, we've also had some announcement that Unilever will be purchasing the stake of minority shareholders in Hindustan Lever, which is tending to bid up the price of defensive stocks in India, and healthcare are part of that story.
So within the energy space, Adrian, how would you position yourself, whether it's oil and gas or coal?
Within energy, I would be underweight at this point in time.
And if we talk about cyclicals, with China's slowdown being reflected in metal prices and resources stocks, should one wait it out?
Well, I'm always amused when asked about cyclicals. I'm the emerging market strategist. 80% of my benchmark is cyclicals. But if we look at what have been the big underperformers year to date, it's been energy and materials within emerging markets. I still think forecasts are too high for refining, petrochemicals, steel, aluminium. And my fear is that earnings revisions will continue to weigh on those sectors and they will underperform, whether they're in India, China, Taiwan, Brazil.
Right, so what about your favorite sectors and which are the ones you're currently underweight on?
Within India, financials, infrastructure would be our overweights, and we would be underweight at the moment consumer discretionary at this point in the cycle because the consumer is facing these higher diesel prices.